crashed the market at 7 a.m. Eastern or Pacific time this morning. It was the good old JOLTS report. And I want to give you some more clarity so you can understand why this report is actually worse than even the headline numbers suggest. So for the JOLTS report, this is the Job Opening and Labor Turnover Report. We saw a really nice move down from 11 million job openings, which is almost 2 job openings per unemployed person, down to 10 million job openings last month. Well, this month we were expecting to go down from 10 million to about 9.5. Unfortunately, we ended up getting job openings that came in at 10.7 mil, and quits barely changed. So let's break this down and understand why this is happening and why it's important. So first, I want you to think about quits. Quits are very different to understand compared to retirements. Quits are not retirements. They are deemed other separations. Quits are not layoffs, which is when companies are firing people, right? Quits are literally just when people say, hey, I think I don't want to work here anymore because I have a better opportunity to make more money somewhere else, or I got enough money and I don't need the job. So quits are really bad because they send the signal to the Federal Reserve that A, people feel like I got so much money I don't need your job, or number 2, they're really bad because they're like, I'm gonna leave here and go get a better job somewhere else. And this is actually what we saw in the last jobs report. We saw that people who stayed at their job year over year had about a wage gain of about 7.5%. Whereas people who left their job to a new job saw their wages go up by about 15%, which is twice the gain if you just switch jobs. And this kind of stuff happens at Silicon Valley all the freaking time, right? I mean, people, they go get a job at Google to go get a job at Amazon to go get a job at Apple, right? And every time you move, like your income is just like, oh yeah, here, lay it on me, baby. Lay it on me. Give me some more money. Give it to me. Thank you very much. So it's really incredible. So what the Fed wants to see, it's really, really critical. The Fed wants to see these quits move down. It's not just about that headline number. It's quits. People are still quitting. and that's a problem. So what you want to see is this quits number not say little changed or changed little the way you see it here. You want to see the quits rate fall substantially. We're not seeing that. In addition to not seeing that quits rate fall, we're actually, and this is what Indeed reported yesterday or 2 days ago on the Blackboard, I made a comment that one of the red flags for the JOLTS report is that Indeed.com was reporting more job openings in September. And everybody's like, what? How could that be? We're going into a recession. There should be less job openings, not more. Why is Indeed.com reporting more job openings? And sure enough, that was a correct leading indicator. The JOLTS numbers skyrocketed by like over 400,000, came in way higher than expected. It's a problem. Not only is that a problem, though, Mr. Nick T, whom we call essentially Nicky Leaks, that's obviously a reference to WikiLeaks, tweets, the number of job openings rose by 437,000 to 10.7 million. The Fed would like to see the ratio of vacancies to unemployed workers decline. And instead, it ticked up. I kid you not. That's what he wrote. He literally wrote that right here. Here's the tweet. The Fed would like to see the ratio decline. And instead, it ticked up. We're going in the wrong direction. Like, we're going in the wrong direction on inflation in Europe. The last inflation report wasn't super exciting. You've got a Fed that's like, hey, we're thinking about lowering, how large our rate hikes are each cycle, but we think we're going to hike for longer. And now you've got these JOLT numbers coming out just a day before the Fed meeting. It's not good. So let's take a look at what Nick tells us, because Nick has some pretty decent insights, and then we have some more insights as well in terms of where some of this is coming from, where these job openings are coming from. So I just want to see if Nick mentions anything, because he gets texts from the Fed, okay? So payroll growth slowed in August and September. Rapid pay and benefits leveled off in the third quarter compared with prior quarters. That's good. We don't want to see a wage price spiral, right? So this is actually good news right here, that the actual level of pay growth is slowing, because the wage price spiral is the worst case scenario for the economy. Absolute worst case scenario. However, while the economy is still growing or losing momentum, it's still growing. Let's see here. I just want to see if there's any note from Mr. T on the Fed. No, the only comment really from him is this: the Fed would like to see the ratio go down, but instead it's going up. Okay, but we already know that. So that has now led the 10-year Treasury to actually bounce back up. This morning, we actually saw the 10-year Treasury fall below 4%. We were down at like 3.93%. And if you take a look at CNBC here, the 10-year top left red box here is back to 4.065. I wouldn't be surprised as well if this is hitting inflation expectations, which I'll pull up some inflation expectations here. But another thing that I really want you to pay attention to is, here are the inflation expectations. Inflation expectations on screen. You can see on the right side, the chart is decently rising. So you've got some like real problems here with the Fed. On one hand, let's write this out. Let's do this together. So here we go. On one hand, you've got bad news over here, what's the bad news? Well, you've got jolts wrong way, inflation, like core inflation, broad and strong. You've got, what else is bad? You've got break evens rising, which isn't good. So that's one problem. Or one set of notes here. Now, if we look at what's good, what do we have? Well, on the good side, and this is what makes this so hard to try to understand, like, gosh, this is so much mess here. And then here, good would be no wage spiral yet. CPI minus shelter equals 0%, right? That's good. Break evens, still at lowest, still at relative lows in last 12 months, right? So you've got this real like mix of good and bad here for the Fed. You've got, again, good. We don't have a wage price spiral yet. We don't have payrolls that suggest they're skyrocketing. They're holding relatively stable. We'll get a jobs report on Friday that'll give us more insight into this. Inflation minus shelter inflation is 0. Like, there is no inflation when you take out the shelter inflation. Core inflation is strong because of shelter inflation. Break evens are trending up because, we're just not trending down as solidly as we should in terms of inflation. And even though the JOLTS report is going in the wrong way, hiring did decline, which is a good thing, but not for the reasons that we think. Take a look at this. In September, the number of hires edged down. But why did they edge down? Well, because school hiring slowed. I mean, that could be seasonally adjusted away, but still, like, okay, so durable goods manufacturing lost jobs and education slowed, but that's not even like good news that hires slowed, even though job openings are up. Why? Because where are the actual jobs going? Right here, folks. Look at where the freaking jobs are going. Accommodation and food service. You know what this says, right? This right here sends a very loud and clear message to the Fed right here. And this is a dangerous line right here. Accommodation and food services, folks. One word. What is the one word that defines what accommodation and food services are? It starts with a D. It's discretionary, which basically means people are bullish on their finances despite stock hell, right? It means you still have people that are like, I'm still spending. Now, to one degree, that's good because it's like, hey, we do want a soft landing. Like, we don't want our economy to stop. We want the economy to to slow. We want inflation to slow, right? We don't want everything to shut down and freeze. But it's bad when job openings are up. When we actually look at hires edging down, the only reason we're edging down is because of education and some durable goods manufacturing. Big deal. But what's really blowing up is accommodation and food services. It's a big deal. And quits aren't going down yet. But leisure and hospitality, arts, entertainment, recreation, accommodation and food services, these sectors blowing up is a sign that people are still spending a lot of discretionary money. And that's a problem. Let me see here. Nope, nothing fun there. So I think this is where you also then look at what you're seeing American Airlines say and companies like Uber say. Now, American, you maybe haven't seen the American one yet. American Express, let's look at a few of these. So you've got, on one hand, American Express. They say that, look at this. Here's American Express's earnings call that just came out. We continue to see no significant signs of stress in our customer base. Actually, this is their older earnings call. Sorry, I pulled the wrong one here. That was, hold on a second here. Yeah, sorry, that's the July report. Where's my recent one? Oh, they said the same thing in the recent one. Oh, here it is. There it is, 10/21. Okay. So this is American Express. They expect delinquency rates to move up slightly, but what about the consumer? Business travel continues to recover. Overall activity remains strong throughout September. And what else? American Express. Pandemic growth programs, that's fine. A little more ramping up hiring. Okay, and ramping up hiring. So continued recovery in business travel and ramping up hiring. Let me see here. Goods and services spending increased 16%, structural shift online, blah, 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 blah. Okay. But in other words, no red flag on the American Express consumer yet, which is a higher income demographic. And if we look at American Airlines, I want to see the American Airlines one. In short, if I can't quickly pull up the American Airlines report, the American Airlines report told us that they were not seeing any kind of slowness in their division. American Airlines continue to deliver on our goals of running a reliable operation. Demand remains strong, and it's clear that customers in the U.S. and other parts of the world continue to value air travel as a way to connect post-pandemic. American has delivered a record of on-time arrival and completion factor so far in October and expects to carry momentum through the upcoming holiday season and beyond. So really, you've got credit card companies, banks, and travel companies telling us that, hey, we're not seeing a slowdown in the consumer yet. That is being reflected in the JOLTS report that we got that is leading the market lower, where we beat expectations. In other words, in a bad way. I guess we could say we missed expectations because we wanted these job openings to come down. But instead, the job openings turned up by over 400,000. Quits changed little. Again, changing little on quits is a bad thing. And this is not retirements. This is different. And even though hires edged down, they only edged down really because of local government education and goods manufacturing. So you've got a really big mixed bag here for the Fed. I don't think we can really expect anything but a hawkish Fed tomorrow. I think we're going to get a really hawkish JPOW. And I think they have to be, because you've got 2 jobs reports coming up, 2 CPI reports coming up. And if those are dirty, it's going to be bad. They're going to have to keep going with the 75s. Now, nobody wants to see that happen, and nobody's actually expecting that, but it's certainly going to move up the terminal Fed funds rate. So anyway, this is why you had pain in markets this morning, where we went from green to red, treasury yield spiking again. It all is based on this report. And there's a lot more than just the headline number in it that unfortunately isn't great for what we're facing. But, you know, if you're one of those folks who believes that 2023 is going to be better than 2022 was, then I agree with you, and I wish you the best, and use it as a buying opportunity. If you see this as more evidence that inflation is going to stick around for longer, yeah, that's possible. You know, Sheldon here says they should have just Volckered us from the start. You know, they probably should have been a lot more aggressive or a lot sooner, but they weren't. So there you go. Demand in retail. Yeah, no kidding. There's a lot. Airline ticket prices are crazy high. Exactly. What you're seeing is a classic inflationary melt-up, says Bob Jones. Walk through a Vegas casino. It's cracking, says Gladiator Rock. Companies are going to have to spend some cash because the new workforce doesn't want to work for 30 years. Yeah, I mean, this seems like a more long-term structural there. Loved your Halloween costume. Thank you very much. Prom here thinks I'm a hypocrite. I'm not exactly sure how I could be a hypocrite when I've been extremely transparent and have been doing exactly what I said I was going to do the entire year, but okay. Someone here says, I don't think the Fed can be dovish until mid-2023. You know, I don't expect their verbiage to change dovish, but I think that markets are going to try to anticipate that U-turn very, very quickly. Let's see. Rather go to bed without dinner than to rise in debt. Benjamin Franklin. Nice. I'm going on a cruise in 2 weeks, and the airline tickets were almost as much as the actual cruise. I'm going on a cruise in 2 weeks as well. Get your shorts ready. 100-point hike. Probably not going to see a 100-point hike. You know, probably not. UK Bank of England, extremely dovish. Probably see inflation at 15% here because of it. Yeah, you know, inflation in the Eurozone is rising. It's not coming down. Scary. Very, very scary. EM says, don't listen to the hating. Hate us. They hate us because they gain us. There you go. Corporate profits up, rates up, employment rising, food, gas, market up, everything up. Everything's great. Well, any chance we could see the top Fed hike to 6 to 7%? You know, nothing is impossible these days. Nothing is impossible. You know, you just cannot rule out these high levels of Fed funds rates. Absolutely. Absolutely possible. Terminal rate, 6.5%. Yeah. Oh, boy. Hike will be 75 in November. I think that's pretty much a guarantee at this point. Pretty much a solid guarantee at this point that we're going to get to 75. That's not going to be the surprise. Everything's going to be all about what Jay Powell says tomorrow. What he says, his words. And I think, you know what would tell us that the Fed is dovish is if they finally realize that those shelter numbers are propping up inflation too high. So if they come out and realize that, and they say, hey, we're starting to see a U-turn in rental and shelter inflation, that would be bullish. Then we go to the freaking moon, and that's what we leave it on. Thanks. See ya.